What if I told you that one of the most popular ways to build wealth, picking your own stocks, is a documented losing game for most people who try it? And what if I said that isn't just an opinion, but a cold, hard mathematical fact? Picture two investors. Both are starting out today with the exact same goal: win long term. One is going to spend their nights hunting for the next big thing, that hidden gem, the single stock that will change their life. The other investor, they're going to follow a strategy so simple, so boring, it's almost always overlooked. They're just going to buy the entire market. By the end of this, the numbers will speak for themselves. Decades of data will show you, without a doubt, which one of them is more likely to come out ahead. The answer isn't just surprising, it's a fundamental truth about how real wealth is built. Number 1. The seductive dream of a 10-bagger. Let's be real, the idea of picking individual stocks is exciting. It plays right into our desire to be the hero of our own story. We all have that daydream of finding the next Amazon before it was Amazon, or getting in on Tesla when it was still in a garage. We hear those rare stories of someone turning a few grand into a fortune, and that powerful fear of missing out, FOMO, kicks right in. The media loves a stock-picking genius. Financial news networks parade analysts who declare with absolute confidence which stocks are a strong buy and which ones you need to sell like yesterday. The whole machine is built around this idea that if you're just smart enough, do enough research, or get one hot tip, you can outsmart everybody else. It feels like a high-stakes game of skill with life-changing rewards. This is the allure of the lottery ticket. It's the promise of a shortcut to wealth, and it is incredibly powerful. But while we're all busy searching for that one winning needle in the haystack, we're ignoring the very nature of the haystack. So let's stop guessing. Let's look at the data. Number 2. The brutal math of stock picking. For decades, academics have studied the performance of individual stocks, and the results are staggering. A landmark study from Arizona State University analyzed pretty much every stock that traded on U.S. exchanges from 1926 to 2022. That's 28,114 different stocks over nearly a century. And what did they find? A mind-blowing 58.6% of these stocks didn't just underperform the market, they couldn't even beat the return of ultra-safe, risk-free one-month treasury bills. In fact, over their lifetime, they actually lost shareholder wealth. Think about that for a second. The majority of all stocks you could have picked were, from a wealth-building perspective, total duds. But it gets even more concentrated. The study found that all of the net wealth created in the stock market over that century came from just the top 4% of performing companies. The other 96% of stocks, as a big group, basically just matched the return of T-bills. You might be thinking, okay, but that's over a century. What about more recently? Fair enough. Let's look at the Russell 3000 index, which covers about 98% of the U.S. stock market from 1987 to 2023. If you would put $10,000 into an index fund that tracks it, your investment would have ballooned to over $350,000. But what about the individual stocks inside that successful index? Well, during that time, 39% of those stocks actually lost money. Another 27% made a profit, but still failed to match the index. Added up, and a full 66% of stocks were losing bets compared to just buying the whole market. That gives you a 1 in 3 chance of randomly picking a stock that will actually outperform the average. 2/3 of the time, you're going to lose money or lag behind the boring index. The game is statistically rigged against you before you add in trading fees, taxes, and the single biggest enemy of any investor, their own emotions. Number 3. The boring champion. Introducing the index fund. So here's the million-dollar question. If most individual stocks are such terrible long-term performers, how does the stock market as a whole keep going up over time? The answer is the incredible explosive power of the winners. That tiny handful of superstar companies, that top 4%, generate such astronomical returns that they drag the average of the entire market up with them. easily covering for the thousands of duds that go nowhere. This is where the index fund strolls in. An index fund isn't magic, it's just a simple, brilliant idea. Instead of trying to find the needles in the haystack, you just buy the whole haystack. It's like a basket that holds a tiny piece of hundreds or even thousands of different companies. An S&P 500 index fund, for instance, holds the 500 largest U.S. companies. A total stock market index fund holds a piece of basically every public company in the country. By owning a single share of an index fund, you are instantly diversified. You own the massive winners that drive all the market's growth, and their success far outweighs the drag from the majority of stocks that go nowhere. You don't have to guess which companies will be the next giants. You just have to bet that over the long haul, American business as a whole will keep innovating and growing. And maybe most importantly, you do it for an absurdly low cost. Which brings us to the most critical part of this whole thing, the unstoppable math of long-term winning. Let's go back to our two investors, Investor A, the stock picker, and Investor B, the index fund investor. Both start with $10,000 and plan to invest for 30 years. Let's say the stock market returns an average of 10% per year, which is right around its long-term historical average.
Investor B, our indexer, buys a total stock market ETF like VTI. The expense ratio for this fund is a tiny 0.03%, so their net return is 9.97% per year. They set up automatic investments and go live their life. Investor A, our stock picker, is smart and dedicated. They're spending hours on research, but they're fighting the brutal odds we just talked about. They pick a few stocks, and because they're human, they sell a winner too early and hold a loser for too long. They're also paying trading fees and generating more taxes from their active trades. Let's be generous and say that after all is said and done, their higher fees, a few bad calls, and behavioral slip-ups cost them just 1% per year compared to the market, so their net return is 9%. Doesn't sound like a huge difference, right? 9.97% versus 9%? But this is the magic or the tyranny of compounding. After 30 years, Investor B, our boring indexer, would see their $10,000 grow to over $173,000. After 30 years, Investor A, our active stock picker, would have about $132,000. That tiny difference in their net return, mostly eaten by fees and the drag of underperformance, cost our stock picker over $40,000. The index fund didn't win because it was smarter, it won because it was cheaper and broader. It captured the market's entire return without the friction and cost of trying to outsmart it. And this doesn't even factor in the tax on your sanity. The ride for a single stock can be sickening. A company can see its stock drop 50% after one bad earnings report. An index, however, has a much smoother journey. That's the difference between sleeping at night during a market downturn and panic selling at the absolute worst possible moment. If you're finding this mathematical breakdown helpful, do me a favor and hit the like button. It really helps the channel and tells me you want more content just like this. Number 5. But what about the geniuses? Right about now, you're probably thinking, okay, fine, but what about Warren Buffett? He picked stocks and became one of the richest people on the planet. And you're right, it is possible to beat the market, but the data shows it's incredibly, vanishingly rare over the long term. For every one Warren Buffett, there are thousands of professional fund managers who try to do the exact same thing and fail spectacularly. Year after year, studies by S&P Dow Jones indices show that over 90% of active fund managers in the US fail to beat their benchmark index over a 15-year period. These are the highly paid pros with teams of analysts and supercomputers. If they can't do it, what makes us think we can from our laptops after work? In fact, what is Warren Buffett's advice for the vast majority of us? In his 2013 letter to shareholders, he couldn't have been more clear. He instructed that the money left to his wife in his will should be invested this way: 90% in a very low-cost S&P 500 index fund and 10% in short-term government bonds. The greatest stock picker in history tells the average person not to pick stocks. He knows the math. He knows that trying to find the exceptions is a fool's errand for most of us. He understands that winning in investing isn't about being a genius, it's about being disciplined. So how do you actually put this winning strategy into practice? It's way simpler than you think. First, open an account with a major low-cost brokerage. Think Vanguard, Fidelity, or Charles Schwab. Second, pick a broad market index fund or ETF. Great choices are funds that track the S&P 500 like VOO or the total stock market like VTI. Pay close attention to the expense ratio. You want that number to be incredibly low, somewhere around 0.03% to 0.09%. This makes sure fees aren't secretly eating away at your returns. Third, be consistent. Set up automatic contributions out of every single paycheck. This is called dollar cost averaging. When the market is high, your fixed dollar amount buys fewer shares. When the market is low, that same amount buys more shares. It automates the discipline of buying low without letting emotion get in the way. And finally, the hardest part, be patient. Let compounding do its magic over decades, not days. Don't check your portfolio every hour. Don't freak out when the news headlines are scary. You're playing the long game, and history has shown time and time again that patience is rewarded. The debate between index funds and single stocks isn't really about which one is better. It's a battle between statistical probability and wishful thinking. That desire to find the one big winner is a powerful feeling, but the math is undeniable. For the vast majority of investors, the most reliable and effective path to building long-term wealth is to stop looking for the needle and just buy the whole haystack. It might feel average, but over time, simply achieving the market's average return will put you far, far ahead of most active investors who try and fail to beat it. Winning in investing isn't about hitting home runs. It's about consistently getting on base, avoiding big errors, and just letting the scoreboard tick up year after boring year. It's the simple and mathematically proven way to win. What's your experience been like? Are you an indexer or a stock picker? Let me know in the comments below. And if you want to keep learning how to build wealth with simple, evidence-based strategies, make sure you subscribe. Thanks for watching.